was a lot of news going into this week, but the big story for sure was the jobs report on Friday morning.
Yeah, and it really was an interesting report. On the headline, it looked like the job market is very strong. The number was 336,000, almost more than twice what was forecast. But when you dug into the weeds, you saw that wage growth actually was at the slowest level since last year, which is certainly something the Fed has been looking for.
And the Fed certainly was looking at this number because through their rate hiking schedule, they want to dampen the economy. And part of that is slowing down jobs growth. But that's really not what we saw.
No, we saw a beat in terms of the number of new jobs created. The bulk of those jobs, however, were in the hospitality services area, which is usually not a source of wage inflation, since so much of that is more like minimum wage with tips not included. So it really wasn't as strong a report as it seemed. And again, the interest rate markets reacted. The 10-year Treasury yield jumped about 12 basis points immediately, but gave back most of those gains by the end of the day.
And by the way, throughout Friday, they ended on a good number, up nearly 400 points Friday afternoon, and we have some reason for optimism from that.
Well, we do certainly. I mean, from a technical perspective, we're nearing a lot of support levels. The percentage of stocks above the 50-day moving average at a very low level, 11%. Fear and greed index, which we talk a lot about, got as low as 16, which is where it was last fall before the market exploded in early 2023. So it's certainly a better time to be buying equities now than it was in July.
So let's talk about that. There's so much negative news out there, and even on our show here, we've talked about a pending issue related to debt that could upset the apple cart. But there is a lot of positive news, and let's turn to what's really going to start here in about a week or so, and that's the earnings.
Right. Earnings are going to start coming out. We get the big banks towards the end of next week. Expectation is for earnings to be flat, but if you X out energy, the expectation is for a 7% year-on-year growth with double-digit forecasts for Q4 and into 2024.
So earnings are looking good. Earnings growth looks good. And you talk about the Federal Reserve, and we've made mention of that through the jobs report and the pending inflation report next week. If the Fed is done, that is also another positive.
Absolutely. We get CPI and PPI next Wednesday and Thursday. That will validate whether these trends we saw in the most recent report continue. The other thing that I thought was interesting, Dave, this goes back a long way. I mean, right now, the United States is paying 4.8% on the 10-year bond. In Greece, they're paying 4%, and in Germany, 2.9%. But in both cases, they have a higher rate of inflation than we do. So I wonder whether, to some degree, people are overreacting in this country about the threat of inflation.
Well, you talk about the Greek debt crisis, and you'll remember that from years ago when the whole world was going to implode, and now their treasury rates are near ours. So I do find that quite humorous. However, let's go back to the positive story and the fact that we see that earnings reports are coming out. We expect a better number. Here's another piece of good news. Oil almost got to $100 a barrel and then did a turnaround.
Right. It's down about 15% in the last 8 trading days. Again, OPEC continues to restrict production, but in this case, there may be just a lack of demand at the moment. We've also seen gasoline prices have come off rather dramatically. I saw a $3.09 at the pump on my way to work the other day. So gasoline prices have backed off as well. So it's very possible, from what I've seen recently, that the Fed may actually engineer a soft landing.
Well, we'll have to see, because you look at a lot of the numbers, and when they've raised interest rates as quickly as they've done, and we've went back 40 or 50 years, that generally is followed by a slowdown. But this time may be different, and that's one of the most important terms in the financial services business, because the outcome is really related to what the inputs are, and I'm talking about a substantial raise in short-term rates.
Right, but I think we have to think about what happened with COVID. Interest rates stayed so low for so long that it allowed companies to refinance at incredibly attractive levels. It allowed homeowners to refinance their mortgages at under 3%. So those folks are not sensitive to higher interest rates. In fact, corporations are benefiting because right now the net interest income they're receiving on their cash is higher than what they're paying in debt. So it's actually a positive net interest cost, which is very unusual.
Yep.